Join me as I go through 3 stocks I'm dying to add to my 200k stock portfolio. I'll be going through their business models, why I've added them to my watch list, plus my valuation assumptions and my price targets. I'll end the video by showcasing my view of what makes a great stock and why I've yet to add any of these stocks to my portfolio. If you'd like a deep dive into other stocks or would like an overview of my portfolio, feel free to check out my channel as well. So yeah, let's start off by looking at the first stock in my watch list, which is Intuitive Surgical. Imagine making money from the future of surgery, where robots do the job and precision is everything. That's what Intuitive Surgical is building. Intuitive Surgical is the maker of the Da Vinci surgical system, a robotic platform used in minimally invasive surgeries. The company earns revenue through 3 streams: selling the surgical systems, that's about 25% of revenue. We also have recurring instruments and accessories used per procedure, that's 55%. And we have servicing those systems, right? That is roughly 20%, with strong recurring income as more procedures are performed. But why is it that I've placed them in my watch list, and what makes them so unique? Well, they have a massive moat, an installed base of over 8,000 systems globally, and a deep integration with hospital workflows and surgeon training. Competitors like Medtronic or Johnson & Johnson are far behind in market penetration. This is a truly amazing company, and the bull case is quite clear. We have an aging population and rising demand for minimally invasive surgeries. We have recurring revenue from procedures that offer strong visibility in terms of revenue forecast, and we have global expansion, which is still early. But of course, it's not all perfect. We have a bear case as well. The valuation is extremely rich. We also have hospitals that may cut capex in a tough economy, and we have increasing competition, which could erode margins in the future. But before moving on to the valuation, let's take a look at a snapshot of the company over the past year. We can see that revenue and EBITDA is upright. 17% and 28% are really strong numbers. We also have a healthy EBITDA margin of 34%, and the current share price has gone up by 38% over the past year. The company is of course American, headquartered in California, and the CEO has been in the role since 2010. But here is where it becomes complex when we look at the valuation. The current share price is $556 per share, and my fair share price, using quite generous assumptions for future growth and profitability, lands at just $235 per share. And that means that the current share price is trading at a premium of 136%, and this also implies an annual compounded return of 10% per year. And this is a classic example of an amazing company with an amazing business model just trading at a way too high price. I usually target 15 to 20 or 25% when doing my valuations, so 10% isn't really that attractive. Now, with that said, my recommendation is currently a hold for the stock, and my final star rating is 4 out of 5 stars. And looking at this table, we can see what happens to the annual compound return if the stock price goes up, right? That's in red, or if the stock price goes down, and that is in green. Now, my fair share price was roughly $230 per share. This means that the stock has to go down by more than 40%, which in my opinion isn't that realistic. However, I would target roughly $400 per share. That gives us about 15%. This also means that the stock price has to go down by about 30%. And yeah, here we can see where the current share price of today lies relative to my own personal price target at roughly $400 per share. We can see that the stock was priced at 400 back in 2024, and then of course it has run up. Now, usually I add these stocks to my watch list, and then I get notified if these stocks reach my price targets. Okay, so moving on to the second stock in my watch list. And what if I told you that the next Chipotle isn't serving burritos, but is dishing up Mediterranean bowls? And that is Cava. Cava is a fast casual Mediterranean restaurant brand. Around 95% of its revenue comes from in-store food sales, with a small but growing slice coming from digital and delivery orders. And the company is vertically integrated. This means that it owns its own supply chain and even produces its own dips and spreads via a recent acquisition. So why have I added Cava to my watch list, and what makes them so unique? Well, Cava is a rare growth story in the US food service. They've cracked a healthy and scalable format. Their average store unit volume is over $2.5 million per year with high margins. And to me, the bull case is also quite clear. We have strong unit economics and rapid expansion underway. We have a brand that resonates with health-conscious younger consumers, and we have minimal national competition within Mediterranean fast casual food. However, there is of course also a bear case. The stock is trading at a sky-high restaurant multiple. We also have execution risk as it scales aggressively. And on top of that, we have inflation and wage pressures, which may squeeze margins in the future. And here we can see a snapshot of Cava over the past year. We can see that revenue has grown by 32%, which is amazing, and EBITDA has grown by 53%. The current EBITDA margin is 13%, which is expanding each year, and the current share price has been basically flat over the past year, and the company is headquartered in Washington, D.C. in the United States. However, when we start looking at the valuation of Cava, it becomes a bit more complex. We can see that the company has a current share price of roughly $83 per share, and looking at my estimates, which I believe are quite generous, I at least get a fair share price of $53 per share. And this also shows us that the current share price is trading at a 55% premium versus at least my fair share price. This also implies an annual compound return of 13% per year, which isn't bad, but at the same time, it isn't great. And just like with Intuitive Surgical, I've given the company a hold recommendation currently and 4 out of 5 stars as my final rating. So where exactly is then my price target for Cava stock? Well, I have my fair share price that's around here, right? Now I'm targeting at least 15%, right? So that would be roughly here, right? At $65 per share. And this means that the stock has to go down by roughly 20% to reach that initial price target. And here basically we can see the stock price of Cava, right? Since 2024, and we can see my initial price target at roughly $65 per share. But you know, it's not that far off, right? I think it's entirely possible that this stock could reach this price within the next year or the next few months. And the final stock in my current watch list is Fico. And for all of you based in the US, Fico is actually much more than just your credit score. You could say Fico is a quiet software beast powering banks, lenders, and risk decisions across the globe. And Fico, also called fairisaacstock, makes money in 2 main ways. We of course have the famous Fico credit score, which is around 40% of revenue, and we actually have software. These are decisioning platforms sold to banks, which is roughly 60% of the company's revenue. And the software side is growing much faster and transitioning into software as a service. This boosts margins and predictability for the future. But the question is, why have I added them to my watch list? Well, you could say that they dominate credit scoring in the US, where Fico is essentially a monopoly. But the bigger story is their analytics and AI decision platforms, which help financial institutions with everything from fraud detection to loan approvals. That IP and data moat is extremely hard to replicate. And in that sense, the bull case is quite clear. We have a irreplaceable position in the US credit system. We have software as a service transition, which drives margin expansion, and we have growing international and enterprise adoption. But we also have a bear case as well, right? The company trades at a massive premium. We also have a heavy reliance on US lending cycles, and we have growth in the core Fico score segment, which has slowed in the past few years. And here we can see essentially a snapshot of Fico over the past year. We can see that revenue and EBITDA have grown nicely, right, in line with each other at roughly 14 and 15%. We see a fantastic EBITDA margin of 44%, and the current share price has risen by 29%. The company is headquartered in Bozeman, Montana in the US, and the CEO started in 2012. And looking at the valuation snapshot, here we can see the same issue as we saw with Intuitive and with Cava, right? We have a current share price, and my fair share price, given quite generous assumptions again, I get at roughly $1,000 per share. And this shows us that the current share price is trading at a 61% premium versus at least my fair share price, and this also implies an annual compound return at roughly 10% per year. And with that said, I have yet again given the company a hold recommendation and a final rating of 4 out of 5 stars. So the question then becomes, what's the target price to get into the stock if you're interested in investing but haven't yet started a position? And here we can see what happens to the annual compound return if the stock goes down or if the stock goes up. Now my fair share price lies at roughly $1,000. This shows us that the stock has to go down by roughly 40% to hit that target price. But I think a more reasonable price target could be in between $1,300 and $1,200, and that applies roughly 13 and 14% per year. And here we can see a stock chart of Fico, and we can see that the stock price has taken a massive beating right in the past few months, where the stock price has at least moved closer to my price target. I think investors simply have realized that the valuation of this company has been too high, but we'll see. If it hits my price target, then I'll add it to my portfolio, but it also could be the case that it just continues up to the right. And to end this video, I'd like to show you what makes a great stock in my opinion on a very simple level. So firstly, the company needs to have a great business. I think all the stocks I've talked about in this video have that. On top of that, the company needs to be well priced. The valuation needs to be attractive. But on top of those two factors, there is a third, which I call momentum. And this means that investors worldwide need to be ready to give the company credit for its performance. There are a lot of stocks out there with great businesses and with great valuations that still don't perform. And if you have all of those factors in a stock, then yeah, you have something really special. Thank you so much for watching. Please write in the comments below what's your opinion about these companies. And if you'd like a detailed one-pager of the valuations for each of these companies, please go down to the description below and you'll find all the links. So yeah, I'll see you in the next one.